Hello and welcome to Kpler's LNG webinar today, where we are going to be looking at how we see the LNG market positioned into the coming winter. My name's Alex Booth. I'm the head of research with Kpler. Today we have a couple of folks from the research team. We have Laura Page, our senior LNG analyst, who is going to be starting the session looking at the LNG supply side of the equation. Then we will move on to Reid Ianson, who is again with Kpler's research team. He's going to be looking at what we see with demand going through into the winter. And we also are joined by Henry Bennett today from Spark Commodities, who is going to be looking at what we're seeing in the forward freight market for LNG this winter as well. Now, before I hand over to Laura, just a quick note to say that we are very excited to be launching our research product next week. It's a kind of a fully fledged access system where you can see everything that we've produced through the last year and a half, and a portal where you'll be able to access all of the research and news that Kpler is producing within the terminal. We'll be sending out an invite later on today for a webinar next week to run through just what that entails. So a really kind of exciting development for us within Kpler. And I will hand you over to Laura, who will run through LNG and the supply side of the equation going into the winter.
Yes, well, thank you very much, Alex, for the introduction, and a really warm welcome to everyone that's on the line today. So as Alex mentioned, I'm going to start off today with really setting the scene with where we're at with LNG pricing at the moment. And it's safe to say that the market's really been on a roller coaster ride over the last year or so. We've gone from record low spot prices at around the $2 per MMBTU mark last summer, up and all the way to record high spot prices in recent weeks. We're now over $30 per MMBTU and rising again, and that's even before winter has got started. So you can see from the chart on the right that through 2019 and most of 2020, the TTF and JKM prices were relatively cheap and well below that of contract prices, and that was due to oversupply. We had a significant ramp up of US export capacity during that time. And finally, we had that wave of LNG supply that the market had been anticipating for a while. And once COVID hit in early 2020, after a mild winter, that really pushed the market to its limits. Now, typically, the LNG market will balance by pushing excess supply into Northwest Europe. But last year, we had an additional response on the supply side, and that was US cargo cancellations. So as the TTF and the JKM continue to drop down towards the US Henry Hub levels, and even below it for a while, it really didn't make sense to load those US cargoes through the summer. Moving to last winter, it was a cold one in Asia, especially in the months of December and January. We saw some players in the region getting caught short, and they were bidding up to secure last-minute cargoes. Now, at this time, there were also a number of supply disruptions happening. So Asia really had to draw supply from the Atlantic basin, and we saw this short, sharp price spike to over $30 for a couple of days in January, which was back then a record high. Now, during this time, as the cargoes were heading to Asia, European LNG imports collapsed, and that led to a quicker drawdown of stocks in Europe. Moving ahead, as we were coming out of winter, it was then Europe's turn to endure quite a cold and prolonged end to the winter, which further depleted those gas storages. Even in April, we were withdrawing from storage, which was typically a time when we would be rebuilding them. Now, this summer, Europe really needed a decent amount of LNG supply to help in its restocking efforts. But strong demand from Asia and also from South America has really pulled those cargoes away from the region. On top of that, as I'll mention in the supply side has been disappointing as well. We have seen some disruptions in the Atlantic basin, which has really limited the supply growth that we've seen this year. And you can see here that the TTF has been rising very sharply. Europe's been trying to compete for those cargoes, but really hasn't been able to draw that supply as the JKM continues to step up in tandem with the TTF price increases we've seen. So we're now heading into winter very soon, with Europe and Asia kind of both competing for cargoes. We have fears that it could be another cold winter as well. So when we were talking about doing a webinar, it was only natural to look at LNG and only natural to look at how prepared the market is for this winter season. So Alex mentioned earlier that I'm going to be covering the supply side, so we'll take a look at that first, and we'll have a look at our expectations for this winter as well. So in the first 9 months of this year so far, we've seen global LNG supply at around 286 million tonnes, which is about 5% up year to date. You can see quite clearly on this waterfall chart that the US has added the most to supply growth this year, and that comes from two main reasons. The first being that we haven't had any US cargo cancellations this summer, which makes sense given that we are in, a record high prices at the moment. We've also seen a bit of new capacity coming online in the last year, which has ramped up to full production this year. Egypt's also been promising too. They've exported more cargoes as domestic gas production has increased, particularly from the Zohr field. And the country is increasingly regaining its capacity to both meet domestic gas demand, but also allocate surplus production for exports. That's through the Idku terminal, but also from the Damietta terminal, which we saw restart in February of this year, and that doubled Egyptian available export capacity to about 12 million tonnes per year. But you'll see on the chart that there have been some declines as well in those red bars, and exports have really dwindled from elsewhere in the Atlantic basin, and that's really weighed on supply growth this year. We've had feed gas issues in Trinidad and Tobago due to lower domestic gas production there. We've had maturing gas fields in Nigeria, so some supply losses in Nigeria too. Plant issues in Peru LNG this summer, and Norway's Hammerfest plant has been offline since September 2020 due to a fire. So we've had about 11 million tonnes of lost supply year on year from these 4 plants alone, which has tightened the market balance alongside the increases in demand we've been seeing from Asia and South America too. So here's another way of looking at the supply losses, but on a more of a global basis. And here I've looked at production at every plant in the world against the typical production level that we'd see. So not comparing against nameplate capacity here. And essentially this chart aggregates all those places where we've seen a dip in production, and it's all tallied up with Kpler's outage tracker as well. Now, it's important to note here we've excluded any plant reductions that have been in response to weak market conditions, such as the US cargo cancellations that I was mentioning earlier, and Egypt also exported less cargoes last year when prices just really weren't that attractive. But I think this chart portrays quite nicely the build-up in supply losses we've seen through this year versus last year and 2019 as well, particularly the grey bars, which you can see at the bottom, which represent the Atlantic basin. But, you know, I've spoken a lot about supply disruptions, and, you know, we have seen unplanned disruptions, but we've also seen planned maintenance being pushed from last year into this year due to the COVID pandemic. Now this month, we're halfway through October nearly, and we're starting to see plants return to full production, which should support supply here on out. But we do think that there will be some areas of the Atlantic basin that will continue to suffer losses this winter. You know, we still don't expect the Norway plant to be online until the end of the first quarter, although it could come earlier. And we still expect there to be feed gas issues in places like Trinidad and possibly Nigeria as well. So we have to see. So taking a look ahead at this winter season as a whole, we anticipate about 8 to 9 million tonnes of additional supply will be added this winter, which will take global exports to over the 200 million tonne mark for the entire winter season period. The supply growth will mainly come from the US. We have 2 new plants coming online, and that's the only place that we're going to see capacity additions this winter. I'll go into the 2 new plants a bit in the next slide. But we also expect continued growth from Egypt. And while we have seen you know, a drop in Egyptian exports through the summer, we do expect that to reverse in Q4 as demand for cooling domestically reduces. But this is all really going to be dependent on gas availability in the country, and we have been quite conservative with the Egyptian export growth for this reason. We also anticipate higher production from Australia this winter. Some plants were offline last winter, such as Gorgon and Prelude. Both of those plants had issues which have now been resolved. I was also looking the other day at the utilisation rates of some of the plants in Australia, and they are pushing higher. Some of them are operating over 100% utilisation at the moment. So that's something to bear in mind as well. Like all forecasts that we do, they have a lot of uncertainties behind them. I've mentioned the unplanned issues and the feed gas supply in the Atlantic. Another you know, risk to this forecast will be weather-related losses in the US in February. So, you know, this year we saw a 30% month-on-month collapse in US exports due to the Texas freeze. We don't expect a repeat of that extreme weather scenario for, you know, February next year. But we have incorporated some kind of loss in February, about 15%, which is the average production loss we've seen in 2019 and 2020. It's something to bear in mind, and it could certainly change this forecast for February. So taking a little look at the US in a bit more detail, I've put together a forecast for US supply for this year, and it comes in at between 37 and 38 million tonnes, which is about a 4 to 5 million tonne increase on last winter. As I mentioned, there will be 2 new trains or plants coming online this winter. Sabine Pass Train 6 will come online, and a brand new plant, a greenfield plant called Calcasieu Pass, will come online as well. We've already seen Sabine Pass receive approval to introduce feed gas last month into the new train. And we'd expect to see first exports as soon as possible, given the market conditions. And we think maybe we could see a first export in November. For Calcasieu Pass, predicting the startup is a bit more uncertain. The plant is a modular one, so it's formed of 18 mini trains of about 0.6 MTPA capacity. And also it's based on different technology to that of Elba Island, so it might be quite difficult to make comparisons on the ramp up speed. But certainly commissioning has begun, but the plant hasn't introduced feed gas yet. So we've assumed we could see a cargo later this year. Certainly when looking at US supply though, it's really notable to add that we do think a substantial portion of supply coming out of the US is spot supply. We anticipate about 3 to 4 million tonnes of supply is spot at the moment. So it's quite interesting to look at where this uncommitted supply could head towards this winter. Given the fact that US cargoes have the flexibility to go wherever they like, and thus arbitrage any structural price differences that we could see between Europe and Asia. So in this slide, I've taken a look at some forward netbacks for the US. And the first point on this chart for November will take a US loading in the month of November. And we've made some assumptions. So we've assumed that it can get to Europe within November, but Asia by December, given the amount of time it takes to get there. We also calculate this using forward spot voyage costs, so taking into account where spot charter rates are throughout the winter season. Now, these calculations were done based on Tuesday's closing prices on the JKM and the TTF. But what it does show is that US spot supply loading through November and December and January would likely target Asia over Europe, given these current pricing. Looking at these netbacks from last week, the two are really finely balanced. So it just shows you that things can quickly change. And we're seeing a lot of volatility on the hubs as well. So yeah, a lot can change from now until those loading times. After that though, US spot supply would likely head to Europe, so any loadings in February or March would likely head there, which is the typical kind of seasonal pattern that we'd see as we go into shoulder season. Certainly though, if this price trend does continue, or we do have a sudden flurry of Asian demand that widens the JKM or TTF spread, one thing to watch out for would be Panama Canal congestion. Now, currently, the number of US cargoes loading to the number of pre-booked slots at the Panama Canal is about 3 times as many. And as US supply ramps up, this is really going to become a growing trend unless we have more capacity for LNG transits through the Panama Canal, which is actually something that is being looked into. I've used data here from Kpler's freight platform, and it does show that last year we did see congestion here at the end of the year. You can see this big jump on the yellow line as cargoes were waiting to pass through the canal. I also used the platform to look at the duration of those vessels for waiting, and a few that didn't obviously have booked slots had to wait about 2 weeks to pass, which is really quite a substantial amount of time. Also interesting to see that we had a jump in June, July time as well. And that was as US cargoes were choosing to go to Asia. But that's since come off as more supply has headed to other regions, so South America and a little bit of Europe as well. But alternative routes are available as well via the Suez Canal and the Cape of Good Hope. But that obviously does come at an increased shipping cost. So one trend that we did see last winter when this heavy congestion hit in December was we saw more cargoes going across the Atlantic basin, and this really gave them the optionality to discharge in Europe or head to Asia via the Suez Canal. So it's certainly something to watch out for this winter. What I would say about this is, though, we'd expect that US off-takers will likely be more prepared for a scenario of seeing some congestion at the Panama Canal if we did have this widening of spreads. But certainly, yes, keep an eye out for this congestion at the Panama Canal. That's it from me on the supply side. I'm now going to pass over to Reid, who's going to cover the demand side. Over to you, Reid.
Thanks so much, Laura. I'm indeed going to be looking at the demand side of this LNG market, which is adding to supply pressures. As Laura so eloquently said, we've certainly seen additional supply come onto the market this year, but given issues in the Atlantic basin, the supply has been left on the table, and certainly demand has picked up this year as well. And so that's only adding to the shortages that we're seeing in the market right now. So if we move forward to the first slide, you'll notice in the graph on the right, this is your year-to-date, year-over-year delta for imports by destination country. So for example, China's the first entry here. Arrivals are up just under 11 million tons between January and September of this year against the same period a year earlier. And the key takeaways on this graph that immediately become prevalent are the delineation between Northeast Asia and Europe. So if you look at this chart, China, South Korea, Japan, Taiwan have all seen sizable increases in LNG arrivals this year. And this has really come at the expense of Europe, especially Northwest Europe, but Europe more broadly. The United Kingdom, Belgium, the Netherlands have all seen declines in arrivals this year. And then you build in the additional factor, that is Brazil especially, has seen arrivals up just over 4 million tons against year earlier levels, driven by the fact that domestic hydropower output within Brazil has been historically weak given a drought within the country. So you have these dual factors of very strong demand out of Northeast Asia and Brazil really pulling volumes from Europe this year. Keep in mind a few notes, especially the Chinese number really sticks out. We will return to this in a moment, but just keep in mind that number is being driven by an especially cold January 2021 for Beijing, as well as strong first half industrial output growth. Just wanted to highlight those factors given the fact that China really sticks out on this graph. We will return to that in a moment. A couple other points. There is the possibility for La Niña this year, which would imply a colder winter for Asia. So it is possible that demand, especially into places like China, could remain quite strong. But this is going to be something that we have to monitor moving forward. If we jump to the next slide, we're going to look at Europe first. Obviously, there is a lot of conversation about supply shortages in Europe right now. And clearly, if you look at the graph on the right, you'll notice the orange bars are simply your percentage delta against the 5-year seasonal average, and the blue bar are LNG imports. And you'll notice right off the bat that inventories are quite depressed, even into September of this year, last month. inventories were off by some 15% against the 5-year seasonal average. This is certainly notable and being driven by several factors, including depressed domestic natural gas production, namely in the Netherlands, weakness in output in the Netherlands, lagging wind power output, as well as a lack of Russian gas volumes, and as displayed on this graph here, insufficient LNG arrivals to really offset these other factors. And again, this goes back to the broader narrative, right? Northeast Asia, Latin America really pulled LNG volumes from Europe this year. And thus LNG arrivals have been unable to make up the difference in any appreciable way. So, you know, the question moving forward is, are shortages going to continue to exist into the winter? Well, this will depend on how cold it gets in Europe and in Asia, and whether Russian gas flows show signs of picking up. So obviously there is a lot of conversation right now in the relationship between Russia and Europe. We have seen a decline in Russian volumes into Europe since August. It's also important to keep in mind that Gazprom storage within Belgium, within Germany, Austria, and the Netherlands are down more than 6 million tons against the 5-year average right now. And so this is certainly another area of concern. If Russian gas flows show signs of picking up, that could certainly help to ease supply shortages within Europe. Keep in mind that LNG arrivals are unlikely to undergo some huge spike in growth. So we're really going to need to see hopefully a milder winter, hopefully a pickup in Russian gas volumes. So now let's move forward to kind of thinking more about the Asian market, specifically China. The graph on the right shows, the bars show gas production, gas imports, and LNG imports. And the orange line displays the overall year-over-year delta. And so you'll know that delta has come off a bit in terms of growth off the June high, thankfully. But Chinese demand growth more broadly has been impressive this year, up nearly 11 million tons, as I had mentioned, on a year-to-date basis through September. This is pretty incredible. This has been driven, again, by pretty cold temperatures in January, as well as strong industrial growth through the first half. The question is, what's going to happen headed into the end of the year, right? This is the big question, because China could be a big source of demand. This is really going to depend on, no surprises, the extent of cold weather. As I had mentioned, La Nina could mean a colder than average winter, but we're going to have to see if that takes place. But the counterfactual to this is the plateauing in industrial output. So this could limit gas demand somewhat within China. More broadly, we have seen since the summertime, Chinese industrial output has really plateaued against year earlier levels. So this could help to counteract higher consumption due to cold temperatures somewhat. But to the degree that might be true, could be limited given the fact that we very well could see coal to gas switching, given shortages in thermal coal availability. As many of us know, China is facing distinct shortages in coal volumes domestically right now. And so that could also certainly help to uplift natural gas demand. One last point before we move forward as well. China is importing record amount of piped gas. In August, they reported a record high. So keep in mind that China is going to lean heavily not only on LNG volumes, but on piped volumes from its nearby neighbors as well. So let's move forward and focus on Japan now. The graph on the right shows LNG imports alongside the seasonal 4-year inventory average for LNG, as well as current inventory levels, LNG inventory levels. Right off the bat, you'll notice September, Japanese inventories are well supplied, about 40% above the 5-year average. This is a good sign, tends to indicate that Japan is well supplied right now. And this is the broader narrative when it comes to thinking about Japan and South Korea more broadly. They tend to be better prepared moving into the winter this year, certainly against year earlier levels. Of course, as I have mentioned, the possibility of a cold weather is certainly a non-zero factor this year in Japan. Domestic meteorology experts there have indicated that there is maybe a 40% probability of a colder than average winter. So certainly a probability, but it is a good sign to see that at least on the LNG front, they are pretty well supplied. And if we move to the next slide, you'll notice nuclear production. And so especially in Japan, nuclear output is broadly higher against year earlier levels, or the expectations for nuclear output are broadly higher against year earlier levels. Again, this kind of builds the narrative that Japan and South Korea, which is also expected to see an uptick in nuclear output this year, are going to be better prepared to take on this winter, especially against last year when they were really scrambling alongside China to find LNG volumes wherever they could. Right. So this is very important to note. You do have this delineation in Asia, right? Not everyone is undersupplied, right? Japan and South Korea look to be better positioned moving into the winter season. So as we kind of close out this demand picture, the broad summary is a continued focus on the delineation between Northeast Asia and Europe is going to be key, but we're also going to need to keep an eye on Russian volumes into Europe, as well as the extent of La Nina, which could affect temperatures in Northeast Asia as well. And this is going to be specifically very important for China, who will likely have to rely on higher LNG imports if that does happen. So as I finish out this demand section, I will hand off to Spark and our freight part of the presentation.
Thanks, Reid, and thanks to Kpler for having me on the webinar. So as Reid said, in this section, we're going to focus on LNG freight rates, so where we are now and how expectations are shaping up for the winter months. If we just move to the next slide, before we jump into it, just a brief introduction. So all of the freight rates and data that we're going to be looking at comes from Spark Commodities. And for those of you not familiar with Spark, we're focused on price transparency in commodities via our technology platform. So since inception 2.5 years ago, we've been heavily focused on LNG freight price transparency, and that's resulted in ICE choosing Spark to partner with in their LNG freight futures that settle against the benchmark Spark 25 Pacific and Spark 30 Atlantic rates. And our platform now has over 200 firms on it. We've also recently integrated the Spark spot rates into the Kpler terminal. So you can now see those Spark benchmark rates alongside all of your Kpler data and analytics. Okay, so if we move on to the next slide to take a look at the freight market as we head into winter. So the first two charts here show the extreme seasonality in LNG freight. So clearly LNG freight has different characteristics to the commodity in that it's higher rates and so not storable across months. And so that seasonality of demand is almost directly translated into the price seasonality. So the chart at the top shows the historical Spark 30, that's the Atlantic spot rates over the last 2.5 years. You can see the move higher in winter 2019 when rates went to over 150K. And then you can see that that was dwarfed last winter when rates spiked to over 300K per day in early January, all the way through to now as we're just moving into the winter months. You can also see the Spark FFA forward curve on the chart below, which we have out to 2024. And this again highlights that seasonality. So we can see the FFA market is pricing in a peak in December at around 150K per day. So that's around the peak of 2019, but well below the highs from last year. Okay, so if we move to the next slide, as I mentioned, we're now moving into the peak winter months for rates. And historically, October has been a transition month into those higher rates. So we can see the top two charts on the right here are the price action in October 2019 and October 2020, with the green dots being the spot rates throughout the month and the green line being the cumulative average over the calendar month. So the short story is that we saw rates basically double over those two previous Octobers. Now we're only halfway through October at this moment, but that seasonal pattern seems to be repeating itself again this year, and potentially in an even more extreme way, as we see that rates have rallied 87% already this month, and obviously we're only 2 weeks into October with another 2 weeks to go. So spot is moving up sharply in line with seasonal patterns. If we move to the next slide, what about expectations for the rest of the year? Well, over recent months, expectations for Q4 values have been quite volatile. So this is based on the Spark FFA forward curve value for Q4. You can see in early August, the FFA curve was pricing Q4 at a little under 150K per day. But over late August and September, the Q4 price moved down quite sharply to around 110K per day. And this was mainly cited as being based on a reduction in expectation for the number of ton miles demanded off the freight market on the back of that continued TTF strength, giving the expectation that perhaps Europe will continue to compete for cargoes further into the winter than maybe was expected previously. We can see that that's now rebounded quite sharply on the back of that sudden tightening in the spot market over the last few days, and also potentially based on the US netback starting to point to Asia again, as Laura pointed out earlier in the webinar. So that leaves current Q4 levels now sitting a little bit above 130K per day. Okay, so if we move to the final slide, how does this all relate to LNG cargo pricing? So the forward curves that you see here are the dollar per MMBTU cost curves for transporting LNG from Sabine to Gate on the left, and from Sabine to Futsu via the Panama on the right. And these use the FFA dollar per day forward curve, as well as assumptions around the fuel consumption and port and canal costs that we get from Spark's partnership with GAC. So you can see that based on the current forward curve, even at peak winter, it costs about $2.50 to move LNG from the US to Northwest Europe, and about $4.50 to move LNG from the US to Asia. And so my main takeaway from this is that with today's very high cargo prices, these freight costs are actually quite a small part of the cost of delivered cargoes. And also importantly, a small part of the spread between a Henry Hub indexed US cargo and a TTF or Northeast Asian LNG priced delivered cargo. So there's certainly still an outstanding question as to whether we will see a significant tightening in the LNG freight market this winter, similar to last winter. But if that were to happen, you could make the argument that the ceiling price for the cargo market, i.e. the point in which freight would start to interfere with cargo economics, based on Henry Hub pricing at least, is a much higher level than the current levels being priced into the forward curve. So onto the last slide, just to conclude, LNG freight spot rates are starting to rally sharply. This is mostly in line with seasonal norms. Expectation for winter rates based on the FFA forward curve are starting to climb, but remain below earlier in the year as some reduction in ton miles on the potential for Europe to compete with Asia for cargoes throughout the winter was priced in. But given the high cargo prices and the Henry Hub to global LNG price spreads, the ceiling to freight rates could be much higher if we do get that tightening in vessel availability. So on that note, thanks for your time, and I'll pass back to Alex and the team.
Brilliant. Thanks, Henry, and Lauren Reed as well. So we have time for some questions. We will start off with one for Laura, looking on demand actually rather than supply side. Laura, it's a question around Latin America and how we see demand going into the winter. I mean, obviously it's been a very tricky region with kind of the drought situation, pulling a lot of cargoes into Brazil, etc. So how do we see this panning out?
Yeah, certainly. We've had increases in demand from Brazil and Argentina this summer. looking forward to the winter, I think that Brazil is still going to be very strong. Their hydro generation in August was the lowest levels we've seen since 2002, which is really something quite significant. As we go through Q4, the market will be heading into peak rainfall season, which should, given the situation, that should boost hydropower reservoirs in Brazil. But during that time, we're also heading into cooling season as well. So, given the two, it really depends on, precipitation rates in the country. But we do think that gas demand is going to be strong. Hydro will increase, but so is overall power demand. Something to look out for Brazil as well is that we have a number of new terminals coming online in the first quarter as well. And we have the existing private LNG terminals that have recently coming online ramp up. So for Brazil, I think it's still going to be quite a strong Q4 and Q1. Looking at Argentina, we're coming off peak levels now, which is typical given that we're coming out of peak winter season at the moment. What I was interested in seeing the other day is Argentina did tender for some cargoes through October to December, which is not something that we'd usually see from the country. So we could still see some couple of imports through the fourth quarter, but certainly it won't be the kind of levels that we've been seeing over the last couple of months.
Brilliant, thanks, Laura. And so a question for Reid now, that we're swinging back across the Atlantic, and there's obviously a lot of discussion, we mentioned it earlier, around what is going to happen with Nord Stream 2. What do you think, what kind of timeline can we be expecting for any changes to Russian pipeline gas coming into Europe?
Obviously, the situation between Russia and Europe is complicated. I'll certainly say that. It is true that Russian gas flows beyond contracted commitments have been slow to materialize this year. As I mentioned earlier in the presentation, and I think it's useful to note again, Gazprom-owned natural gas storage in the Netherlands, Germany, and Austria are at seasonally depressed levels, lower by more than 6 million tons against the 5-year average, right? And we saw no builds into that inventory space through the summer months. That's notable. But it is also true that domestic Russian gas stocks have only recently filled to adequate levels. So I think you have this competition of geopolitics, because Putin certainly wants to see longer-term contractual agreements with Europe and a quick approval of Nord Stream 2 with the economics of supply within Russia. Also important to note, Biden has had an aide in contact with Russia concerning the situation. So, the United States certainly feels that there is a geopolitical element to this. So moving forward, I can't give an answer of when we might see flows. It is very possible that volumes start to pick up through the end of the year, given the fact that Russian gas stocks have finally filled to adequate levels, but there is certainly a geopolitical element at play here.
Brilliant. And we'll stick with you, Reid, as well. And staying in the region, we've had a question around: do we think the recent announcement of possible EU intervention in the gas market would affect LNG cargoes coming into Europe, or will the Asian markets continue to be more attractive going forwards?
So the intervention being discussed right now is joint purchasing to create some kind of strategic reserve. At the end of the day, you have a limited amount of supply. Maybe joint purchases across EU countries would have some influence on prices to the downside, but at the end of the day, we're still facing shortages. and the effects of that kind of intervention are limited. Also important to keep in mind that there is a lot of disagreement among EU member states right now about how to attack this problem with regulation. Places like Germany don't necessarily want to see a lot of intervention. So it's going to kind of be a question of, can the European Commission come together and form some kind of agreement? But again, any agreement's going to be limited because you're still coming up against the fact that supply is falling short of demand, and prices will respond as a result.
Brilliant, thanks. So back to Laura, and we're staying within the broader European region as well. So question on Algeria and Morocco. So it's a particularly tricky situation in North Africa at the moment. So how do we see the Algerian-Moroccan situation, and will there be more LNG delivered from Algeria to Spain to make up for the lack of pipeline deliveries?
Yeah, interesting question. I did write some analysis on this a couple of weeks ago. So for those of you that don't know the background here, Algeria has two pipelines that head into Spain. One goes direct to Spain, and the second one goes via Morocco into Spain. The transit agreement for that Algeria-Morocco-Spain route, the Maghreb pipeline, is coming to an end on the 31st of October. And there has been a lot of, talk between, Spain, Morocco and Algeria. Algeria and Morocco have some tensions at the moment, and there are some concerns that perhaps the transit contract will not be renewed. This would leave Spain without as much pipeline gas. In my opinion, Morocco needs the gas. So some of the gas that goes through this pipeline goes into the Moroccan domestic market. And Morocco doesn't have that many other alternative sources of gas supply. So they do have a bit of domestic production, but certainly not enough to meet their domestic needs. So from Morocco's perspective, I believe that they would want to get this transit deal renewed. What this means for Spain, if it doesn't get renewed, is they will need more gas. Now, Algeria has excess LNG capacity, and they can take the gas that would have gone through Maghreb and reroute it to the LNG terminals. And also, Spain has excess import capacity as well. What we would have to see, though, is Sonatrach chartering more vessels and potentially, purchasing import capacity in Spain. So, the next couple of weeks are going to be crucial for this situation. And I think, a deal might be done, but if not, we can certainly see LNG going into Spain. But, like I said, we're going to need tankers, and we're going to need import capacity in Spain to be sorted out. So we'll have to see what happens on the 1st of November.
Brilliant. And so last question, just to wrap up on time today, and that's covering the margins that we're seeing at the moment for certain players have to be kind of fantastic given the transacted values of LNG cargoes. So the question is, in general, who's capturing the margins on the arbitrage between, say, the exporting countries and then the importing countries? Which kind of player is it that's gaining the most from this, do we think?
Yeah, so most of the supply coming out of the US is going to the off-takers of these plants, so the portfolio companies, the utilities. So we think, a lot of the margins are going to them. Of course, when you have big portfolio companies like Shell, they also have long-term contracts to meet as well. So, not all of the supply coming out of the US and going to these players is spot contracts. You know, some is going to long-term contracts which are oil linked. But you know, some of the operators, such as Cheniere, which is the biggest one in the US, they have also reserved some production for themselves, so they could also be taking advantage of these spreads between, you know, the US Henry Hub and the JKM price as well. So it's really a bit of a mixture between the off-takers and the plant operators, the larger ones such as Cheniere.
Excellent. Thank you very much. I'm sorry that we haven't got time to run through all of the questions. There's a few more that we haven't, unfortunately, haven't managed to get around to. Just want to say thank you to everyone for joining us today, and we look forward to speaking to you again in the future.